Hey there, welcome back to the channel. Okay, I haven't recorded since I think I was in Mexico. So where have I been? I've been off making up my own corporation. Why on earth would one want to do this? Taxes, of course. I want to save money. So I started my digital nomad life as a W-2 employee, switched over to 1099. And this year when I was doing my taxes, I realized I could have done better as a 1099 employee saving taxes. And I was chatting with my tax guy, and I was thinking, oh, well, let's set up an S-Corp or something and try to save some money. And he said, dude, do a C-Corp. And I thought he was crazy, but I researched it. So let's stop here and talk about what advice you should take from a random YouTube guy. Very little, I would suggest. This is my experience with taxes. I'm not a tax professional. So follow my guidelines at your own peril. These aren't even guidelines, these are ideas. Okay, moving on. Disclaimers aside. So since my tax guy said look at a C Corp, I did. And let's talk about why one might do a C Corp versus an S Corp versus a pass-through. And again, this is for digital nomads, expats, people who are living outside of the US most of the year, if not all the year. Okay, let's go to PowerPoint for a while. Okay, I know everybody loves PowerPoint. Let's talk about the three options we have as expat freelancers, expat digital nomads, immigrants, whatever you like to call yourself. We're all living outside the US for more than 334 days a year, whatever it is to get foreign earned income exclusion to kick in. Okay, so you can do pass through Schedule C. It's what I did the first time I was 1099. First year I was 1099. Super easy. Just file a Schedule C, golden. You can do an S Corp, more paperwork, has some advantages under certain situations. Or C Corp, total pain in the ass, but potentially better tax savings. Let's first talk about S Corps. So S Corps are all the rage for freelancers on the internet. Why? Well, it can save you a lot of money. Basically, if you're 1099, you have to pay upfront, no way around it, 15.3% of your income off to the federal government in the form of self-employment tax. It's basically your Social Security and Medicare, both the corporate and personal side paid out to the government. That hurts. Then on top of that, you get to pay all your income taxes. That's not even your income taxes. So what the S Corp folks do is they take they reduce your salary to something reasonable. Can't be super low. It has to be reasonable. There's guidelines from the IRS about it. If you want to do this, go read the guidelines. And then you give yourself dividends, and those dividends are taxed, but reduces your self-employment tax. That can be good unless you're an expat. Then it doesn't help you at all because all you did was turn what you could have excluded in foreign earned income into a non-excludable dividend that you have to pay taxes on. If all your money's in one pool, that's good. If you're an expat where you've got money that is foreign earned income excluded and money that's not foreign earned income excluded, and you just take a whole bunch of the money that you could have excluded it and turn it into a taxable income that's taxed higher than the self-employment tax, that's not a good idea. So S Corps for a digital nomad probably don't make a lot of sense. Sorry about this slide. This is a little bit of an eyesore. So the problem with S Corps and Schedule C is they're both pass-through entities, which means you and the company are one and the same. And so when you're working as an expat, there are some really subtle rules that come into play here that just kill your tax savings if you're not careful. Let's take this simple example here on the left, where you make 170,000, you have $20,000 worth of expenses. Yay, that's not a bad year. Not a bad year to me, at least. I think that'd be a good year. So if you don't know the tax code and you're wishful, like probably of my first earlier videos, why I say never take tax advice from random YouTubers, you take the 170, you knock off the 130 foreign earned income exclusion, you're down to 40,000, knock off your 20,000 in expenses, knock off your 15,000 in the standard deduction, you're down to 5,000 in taxable income. Awesome. That's a great concept. Only trouble is it's illegal and it's not really what the tax law says. So That's a good way to get yourself a nice IRS audit and pay extra money. So what really happens here is that 20,000 is adjusted by the same proportion of your excluded income. So if you exclude 130,000 from 170,000, that fraction of your excluded income to your gross income also reduces your uh, the amount that you can deduct. So that deductible 20,000 actually in this scenario comes out to only be $4,700 worth of allowable deductions. This is an obscure formula buried deep. It's why I hire a tax guy who knows how to do this stuff for me to catch these mistakes. He showed me this, he caught it, kept me from getting in trouble last year on this one. Made me very unhappy because I couldn't deduct as much as I thought I could, but I stayed legal, which is the most important. So this is the problem with both of the pass-through entities. When you take the foreign earned income, you also have to reduce your expenses by the same amount of your reduced income. Is there a better way? Why, yes, there is, you ask. So a C Corp is the better way. Now, C Corp, is it a pain in the ass to set up? Absolutely. Does it require more work? Absolutely. Do you end up having to be double taxed? No, not if you're careful. So what C Corp does is cleanly separates you from the business. You get paid a salary. You have to pay yourself W-2. You have to fill out W-2s. You have to do all the corporate stuff. You could hire somebody to do that for you, or you just get to learn QuickBooks, which is where I've been for the past couple of months, is trying to understand and master QuickBooks to keep my accounting correct. Because it's really important to keep your accounting correct on this. And I hope I am. So, but with this clear separation, that $20,000 worth of expenses, even when you're living outside the country, stays a $20,000 business expense. Your income is your W-2 income. It's whatever you pay yourself. There are guidelines from the IRS on how much you have to pay yourself. You can't pay yourself zero. Well, maybe you can as a corp, but you wouldn't want to. What you want to do is make sure you pay yourself, at least in my mind, up to that excludable income level. So you pay yourself 130,000, or you pay yourself 145, where you exclude the 130, and then you have your 15,000 in standard deduction. Anything in there, as long as you are not in a position where you are paying personal income tax. Now, there's good reason to bring your salary down even further if you can, because that reduces your Social Security tax, which now the company is paying half. That still comes out of your pocket because you own the company, and the other half comes out of your W-2. So if you pay yourself lower amounts, you don't have to pay as much in Social Security. But then you could have leftover money in the company, which you don't want either. So you have to play some games there. My suggestion, well, I'm not going to give you a suggestion. You work out what's best for you. I go lower than that cap, but I keep it fair and reasonable for the type of work that I'm doing. So it's still a reasonable salary as far as the IRS is concerned. So this is awesome, but it is more work. But you do get that full $20,000 worth of expenses. You can reduce your salary and reduce your payroll taxes. So that's good. Bad part, you got to be careful not to have leftover corporate salary. Maybe you don't care. Maybe you're say, fine, I'll pay that 21% tax on the corporate salary, leave it in the corporation, invest it, do whatever I want there. Okay, so this slide is sort of just a little quick comparison where, you have your gross income's the same, your expenses are the same, what you can deduct stays at 20,000. As a pass-through, you have to reduce that down in proportion to the foreign earned income exclusion. You can reduce your overall net, reducing your taxable income. This is why C Corps are nice. So one thing you don't want is leftover money in your C Corp. At least I don't think you want leftover money because you have to pay taxes on that. But here's a wonderful thing about C Corps. It's a target-rich environment for tax expenses legally. Now, when you're working as a pass-through, you can buy your healthcare, but all that healthcare is paid for post-tax money. So you've already paid your income tax, you've already paid your self-employment tax on that money. So you've already taken 40% of that money away, and what piddly left over after that, then you're buying health insurance with it. When you're doing it as a C Corp, that can become a benefit from your C Corp. So that money is not taxed. That is not taxable income to you, and the corporation does not have to pay taxes on that money because that is a benefit, a tax-free benefit to the employee, you. So healthcare is a great way. Now you do have to set it up right. There's paperwork involved in this, and you have to declare it correctly. This video is not going to go into that, but you can make healthcare a benefit of the company and make it a tax-free benefit. And you can be quite generous to yourself with this, which, as an older expat needing healthcare, that's a very big deal to me because healthcare is expensive. Uh, I will say one caveat. If you just look at corporate bylaws normally in corporate taxes, there is a requirement for healthcare to be ACA compatible, which you're never going to find as an expat outside the US. But there is a rule that I found through ChatGPT that if you're declared expat, that rule doesn't apply to you. Double check it yourself. That allows you to use foreign healthcare money for that expense. Double check it yourself. As a digital nomad, I expect you're like me and you have a lot of travel expenses. I have to travel back to the US for work sometimes. I have to travel to Europe for work. I'm always scouting for new work locations. I'm doing video reviews of planes. These are tax deductible expenses. So that money doesn't come to me ever. This is deducted from the business side of it. So it doesn't count into my taxable income, and I don't have to deal with mixing with that in my personal income. A huge benefit, 401k plans. If you think you're going to have leftover money in your corporation, set up a company contributed 401k plan to yourself. Again, there's paperwork involved. This is not a no-brainer. You've got to research, you got to find a plan, you got to do the work for it. But it's not going to take you that much time. And then any leftover money up into that 25% of your salary contribution limit, you can put into a 401k plan for yourself. That's not taxable money. You still have all the normal pass-throughs of normal tax deductions of a pass-through business. All your marketing, your professionals, the cost of QuickBooks, the cost of the lawyers and the accountants and the tax professionals that you might consult. All of your software for business is deductible from your corporate side of the house outside of your income. So you keep those two totally separate. Another big one, it's not big actually, but another fun one for travel enthusiast is business travel cards. Those travel card high fees, like you have on the Amex and what you have on the Reserve card from Sapphire, you can get business versions of those cards, and that cost of the card is a business expense. I haven't done that because I really can't justify one, because I actually you do have to be able to justify it as a proper business expense. One thing I do is I have a card that is split between personal and business travel. I have to have an accountable plan for that card. And I have to prove to my company, to prove to myself from myself, that I do use at least half of for travel, and then I take half of that cost expense off business expenses. I still have to pay the other half out of my own pocket. But there's lots of taxable advantages to having a C Corp. It's a target-rich environment for you, ChatGPT, and your tax guy to work with. So this is why I chose it. Is saving me thousands and thousands of dollars in taxes, which is going back into my pocket, which I like. So you can see C Corp has a lot of tax advantages. I've said this a couple times already. It is most definitely a pain in the neck to set everything up. There's a lot of paperwork, accounting that needs to go into it. But for me, it's worth it because it's saving lots of money. And also, it's worth it to me because it forces me to keep that clean separation and to make sure that I'm doing everything legal and proper. When I'm mixing it as pass through, it gets a little bit more muddied and it's harder to remember to keep things separate, whereas the C Corp forces your hand on that. So I hope you find this interesting. I hope to see you out there traveling. If you do a C Corp or an S Corp or simple pass through, drop me a comment. Let me know what you guys do. And if you think this is all a bunch of crap, by all means, comment on that too. Take care. See you on the road.